Hi, welcome to Traders Chat. This is Chart Gal Lori, and I'm with Bob Coleman. And I'm so excited to meet Bob virtually. Hello.
Hi, Laurie.
Thank you so much for joining me. I know you're a busy, busy man. So I'm going to introduce you a little bit because I can't do your resume justice. I'm going to show this is your website, goldsilvervault.com, and this is Bob's background. And of course, I want you to tell me a little bit more about yourself verbally. And then we have Bob Coleman at Profits Plus ID. Oh, Idaho, duh. At Profits Plus ID on Twitter. So thank you.
Sure, my pleasure.
All right, tell me what you do, and it looks real fancy behind you, Idaho Armored Vault. If you could tell me a little bit about yourself and your business.
Yeah, basically, I've been in the investment business since 1992. I've been a registered investment advisor, broker, that type of thing with some of the bigger trading houses back in the 90s. I opened up my own registered investment advisory practice. I run a hedge fund, a physical metals hedge fund as well. And then we also run one of the larger private depositories in the country. Everything we do is fully segregated, so we deal with the physical metals. I also get involved with buying and selling metals on the transaction side, so we can create a deep two-way market here at the depository. In addition to that, premium-wise, we beat every dealer in the country on price, and we've been doing so. The last year and a half has been just dramatic in terms of how much premiums have gone up on products.
Yes.
Now, not only gold and silver, but the large as well as small products. So we try to help clients save a lot of money on that type of transaction, as well as investors that have metals, for instance, at the COMEX, where they have it on receipt, or they have some of these structured programs out of the country, or say, back in New York or some of the other central hubs. We can help people organize, transport, and provide the logistical support for pulling delivery of those metals from those programs, so people don't have to buy and sell, or sell and then rebuy. So it reduces costs there. So we put on a lot of different hats to help people, get involved with the precious metals. There's certainly a lot of advantages to the metals right now, especially with inflation rising,
Yes.
and obviously the undervaluation we feel in, especially in the silver market. I think there's a lot of room for the upside for the metals in general to not only garner attention, but obviously move up in price.
Right. And I should mention that this is Traders Chat, so typically we speak with other traders. We teach technical analysis, and we talk to others about technical analysis. But there is a unique fundamental, area or perspective to gold, and our members and our subscribers are very interested in that. So I always say we go wide, not deep. Like I know this much about bonds, I know this much about gold, and so I can trade them all. I just know enough of the correlations and divergences. So this is different. Instead of deep and wide, we're going narrow and deep to get more into the subject. So again, thank you, and thank you for that background. How did you get into metals?
Back in 2006, I was always sort of into the metals, even back in the 90s, but 2006 is when I saw the system leveraging up. You had the housing crisis, or not, the crisis not at that point yet, but you saw the housing boom, you saw the leveraging that was happening inside the financial system amongst the financial institutions and so forth. So I wanted to start looking at assets that were held outside the system, because I was really concerned about systemic risk, counterparty risk, just the numerous other types of risks that I saw coming down the pike. And 2008 hadn't happened yet, so I was sort of ahead of the curve there. So we looked at a lot of depositories throughout the country. We looked at a lot of programs around the world, and a commonality between a lot of these programs and the depositories was that the depository was run by a gold dealer or a financial institution or some type of cash in transit company. So the premise, or the main revenue model, was transaction business, not necessarily storage fee revenue type business. So
Right.
in our model, we went the exact opposite path. I opened a facility up to base it on storage fee revenue first, transaction business second. So one, we could offer very, very competitive rates on the storage fee side to segregate and insure clients' metals. But the second item was we can actually by not relying on transaction revenue, when we do transactions, we don't have to mark it up nearly as much as what you typically see from a typical dealer.
So that's how you offset that with the storage fees, so you can bring the premiums down just a little bit. I understand, just a little, just a little. Sure. So what is your take? I'm just going to hit you with the hard question first, that I have no fundamental bias toward Bitcoin. I'm just curious, in your world, and I know you can't speak for the entire industry, what is the gold view of Bitcoin?
I think from a to try and get the money printing and the competitive devaluation of currency message and storyline, and the try to save your purchasing power perspective, I think the cryptocurrencies have done a wonderful job of getting the younger generation sort of hip into this idea of what central banks are doing, what governments are doing in terms of debasing currencies and trying to use inflation to kind of kick the can down the road in terms of when debts are due and so forth. So I think that does a wonderful job there. Gold obviously has 5,000 years of history. It's been money for a very long time. It's sort of, I kind of call it it's a tortoise and a hare sort of syndrome, where you have the cryptocurrencies are moving at lightning speed right now, especially in price, where gold is sort of, it kind of chugs along, but that's what gold does.
Right.
It's a much more established, much more mature market. And so the issue that I have with cryptocurrencies in general is the counterparty risk perspective, as well as it's been born into an era where we've only seen money printing.
Sorry.
We haven't. No, that's okay. Yeah, we haven't seen what happens when you have hiccups in the system. Like March of 2020 was a great example. The markets collapsed very quickly, and the digital coins and cryptocurrencies collapse as well. So you get to see what happens when you have downside action in the economy. Whereas gold is one of those things. It'll outlast us.
Right.
So it's a matter of just what I call time in the market versus timing in the market, because I don't see the central banks and governments ever backing away from their inflationary policies. They just can't. The system is too embedded right now on debt creation and to try and maintain asset prices and so forth. And that'll work for a period of time, but at some point, all this money printing becomes very toxic, and the inflation starts to really pick up. And I think that's where we're at now. And the metals, I think, are poised to really start to move. And if you look at, obviously, I look at technical factors as well on the charting side, and you look at these large cup and handle type formations, especially on silver on a long-term picture. There's a great setup that's starting to take place. I just did a presentation up at the Silver Symposium up in Coeur d'Alene a couple weeks ago, talked about how the deleveraging of the silver market, as well as gold in general, with a number of the regulatory oversights or Basel III and some of the nuances that are happening, is forcing a reduction in long interest on the futures market, for example. And so shorts have been building up, and so it's primed to say when the prices start to go up and shorts start to get squeezed.
To squeeze them, yeah.
Yeah, I think you're going to see that happen on the silver market. It's the characteristics are all there for that to happen.
And speaking of money and currencies, I heard someone mention, I was reading it online, but that our dollars in the bank are like a pile of melting ice, losing their value so quickly. So I feel you on that, and I agree. And then gold's in a monthly equilibrium. It's trying to figure out where the buyers and sellers, who's going to win this war. But we see that silver is better positioned bullishly as well.
Yeah, it's interesting. Part of my presentation was that I talked about how the futures market really dictates or has dictated the price action for gold itself. And even though the futures market, which is a derivatives market, it's based more on a hedging and trading scenario than the actual supply and demand of the metal itself. If you look at the market outside of the derivatives market, you've seen steady accumulation. You haven't really seen any selling, especially by secondary or just investors in general. You don't see a lot of secondary metal coming back onto the market. And you see central banks. They've been big buyers of gold earlier this year. The first 6 months of this year was an enormous amount of buying. They're starting to buy again because the prices are low. I think even central banks are realizing, hey, in this world of overpriced assets and inflated levels of whether it's real estate, stocks, especially bonds with the low interest rates, the metals, like silver, for example, is cheaper now relative to the S&P 500 than it was back in the early 1970s. It's insane, to see how underperformed silver has done relative to gold or relative to the stock market over that same period of time.
Right. And you answered this initially talking about storage fees and the various components that make up price, but why so this is probably a silly question, I should know this, but why is the divergence between futures price and spot price, and going out and trying to buy a coin and you see that silver's 20 something dollars, you got to pay $34 for a coin? Why does that gap continue to widen?
Well, it's a big question.
And dumb it down for me, please.
Oh no, and I'll shoot it to you straight. What's happening this last year and a half when COVID hit? Right before COVID hit, 2019, there wasn't much interest in the metals. Premiums were really, really low when clients were selling back metals. Wholesalers were paying a discount for gold eagles. It was that bad.
Wow.
COVID hits. You had supply chain issues. You had the spread between London spot price and the New York futures market blow out because you had a lot of people using the COMEX in New York as a hedging vehicle against their physical position. It's typically how a lot of banks and users will trade the physical metal or their own inventory. And then all of a sudden, when you had that supply chain issue and everything shut down, individuals or banks they couldn't deliver against their long position, so therefore they had to buy back the short position at whatever price it was, and so you saw this massive blowout with premiums $65 more in New York than it was in London. It was crazy, and banks took they said tens of millions of dollars in losses that day. Well, fast forward, what happened with premiums on products is you had logistics issues, you had production issues, you had some supply issues, and all of a sudden the retail dealer saw this and capitalized and started marking up product at a very accelerated rate. And then you had the wholesalers also try to keep up with this, and they marked up product as well. So by the time the normal investor went to go buy his coin or his bar, he was paying these extremely inflated rates, but it wasn't all because of inflation. A lot of it was just a lot of markup. A lot of these dealers wanted to make a lot of money and make back for what they had maybe lost over 2018 and 19 when business was really slow. And so it forced.
They just took advantage of the supply and demand. They just took advantage of it.
Big time. And this is where, what I've been selling product for, our loyalty to our client base is second to none. We are much more loyal to the client than we are to the premium or to the product we're selling. So we've been on average beating most dealers on the street for the exact same product by $2 to $3 an ounce in silver. I mean, we're talking big time numbers here, and it's saved people tens of thousands of dollars in premiums just by saving money rather than overpaying and giving your purchasing power to a retail dealer. The online dealers are, they've been reaping some enormous profits off this, and you see it with some of the publicly traded stocks and so forth that trade precious metals. But that's part of the nuance, is that you got to really shop out there, and it's hard to because there's not very many online dealers. Most of them see what each other's selling the same product for, and that's why. Running a depository, we buy from wholesalers. I know exactly what most of these other dealers are getting their product for. I know what their markups are. So by keeping that markup really, really low and passing the savings on to the client, we're able to obviously get more business, but also develop a great following.
That's wonderful. And I'm going to have to read this question, so just excuse me because I'm just, let's see. Well, I understand this one. A couple months ago, we had the plunge in gold overnight with multiple sources citing margin calls. It seems like gold gets hit on holidays and low liquidity moments. Why does this happen? And we don't like to use the word market manipulation because, the market is going to establish that supply and demand and that price zone. So we don't like saying that. But is it market manipulation?
Oh, every market's manipulated. I mean, and it's not by speculation. Yeah, you've had the forex manipulation. You've had settlements by the banks paying for whether it's spoofing of transactions, where you've had trading desks put too much size on the offer or on the bid to try and sway the market in a direction. You've had the LIBOR rigging scandal. I mean, you've had numerous instances where because of all this money printing, there's so much money sloshing around. There's no way to manage all this, and so I think that's where when you talk about these overnight or in the middle of the night smashes that you
Right.
see, like in gold and silver, and you also see it to the upside too. It doesn't always happen to
Absolutely.
the downside. But the problem you run into is with gold and silver, especially when it's off the exchange hours. It may be, and I've seen this really when you're between after the New York close and you're before the Tokyo or Hong Kong Open, for example. You have that sort of window there where there's not much activity. You see stop losses getting smashed. You see price levels break, and maybe it's nefarious players that are trying to aim for a certain price to start the waterfall. But basically, when they hit that stop loss number, it just starts to accumulate, and it just gets run.
It's
and
snowball.
Yeah.
And is a component of it the margin requirements because they increase after hours? So when they open up and they're down a little bit or up a little bit, and it causes these margin liquidations, is that part of the equation?
It could, but the margin, especially in after hours, it's dependent upon each clearing firm if they want to create the margin call that moment, in the middle of the night to a client. Typically, it's more stop losses that are in place, and those stop losses are being run, and then the next morning, when business comes back into play in normal operating hours, the margin clerks will say, listen, you either got to pony up more money or we're going to sell you out of your position.
Yeah.
It depends on each clearing firm and the size of the drop. And just like on the upside, the size of the move, if you're short the market and you have to start covering.
Yeah.
But yeah, margin rates have a big effect, especially when you see a hike in gold and silver on the margin side, you tend to see a liquidation start to happen because it is a very heavily leveraged commodity.
You see the long squeeze or the short squeeze, whichever one. Here's the question I don't understand, but it came from one of our members, so I'm just going to read it. Do dealers sell futures and take delivery from exchange to lock in the difference of premium of futures over spot?
It depends on the dealers that you're talking about. If you're talking about a retail dealer, they're just going to buy product typically from their wholesaler, and they may use the futures market to hedge their price exposure, so they try to neutralize price exposure of their inventory. So, for instance, if you're buying 5,000 Silver Eagles from your wholesaler, and now that's in inventory waiting to be sold, but you don't want the price fluctuation to kill your profit margin, you may go into the futures market and sell one contract, so you're net neutral in price. So if the price drops,
I do understand that. I didn't understand the question that well, but I do understand what you just explained. So thank you. So you do that.
Yeah, that's one effective method. Depending on if it's a refiner, for example, they may go into the futures market, buy 1,000-ounce bars off the exchange. If they can't get it from mining operations and so forth, and they can't melt it down and make 1,000-ounce bars, they may buy 1,000-ounce bars, and then they can actually sell those to another fabricator or mint, for example, at a higher premium. And affect a transaction that way for revenue as well. So that depends on the player that's doing that business.
So for predicting your business and your industry, do you rely heavily on the futures price or spot price or neither?
I look at both. The spot price is what our prices are based off of, the London market side. So when you're dealing with physical metal, the issue with New York and the futures market is you have, depending on your lead month contract, if it's just rolled over, or if let's just say you're 2 or 3 months out, the lead month contract, you're going to have a higher price over spot, just the natural contango there. But the issue that I see in the business, and people have to be very aware of this, is that there are retail dealers that will use the COMEX pricing to advertise as their spot price, even though the London price may be 8 or 10 cents cheaper to buy that same product. So you want to be careful. Ask the retail dealer. Are they basing their spot price off of New York's the COMEX's pricing, or are they basing it off of the London market for purchasing transactions? So those are just nuances. I mean, the nice thing about the COMEX is it's very regulated, it's very transparent, it's very trackable, so you can chart it and you can do a lot of studying and technical work off of that.
Right.
Whereas the London market, it's a little bit more opaque. It's especially when you talk about fixes, the gold fix is done twice a day. You don't have that ebb and flow, from a chart standpoint.
And that's something we never look at. We never look at the London market. So this is all new information for me. So do you, I think you already said this, you see an increased demand for physical assets recently since COVID?
Yeah, you really, since 2018, you've really seen the high net worth investor, institutional investor coming into this market and diversifying into physical metal. And they do that not just because maybe prices are cheap. They do it because of long-term policy actions, whether it's tax policy, political implications, geopolitical issues around the world, inflationary effects that the central banks are doing by inflating their balance sheet, zero interest rate policy, massive valuations when it comes to the stock market, risk aversion. There's a number of different reasons why negative real interest rates. There's various reasons, but you're seeing consistency with the higher net worth individuals saying, listen, the world looks uncertain.
Yeah.
We've never experienced this in our lives, to see $29 trillion in debt, and it just seems like it's going to keep growing forever until something breaks, and the central banks are just going to ratchet up their balance sheets until something breaks. So everyone's trying to say, listen, I need to protect or have some insurance policy. And that's really where the metals come
against
from.
the dollar, because, again, the dollar is the melting pile of ice. So what do you think about what's the best way to accumulate physical gold and silver?
For the small investor or even high net worth investor, buying products, I've always kind of told clients, try to find the best price product for the best premium. Not necessarily have one go-to product all the time, because, like, for instance, there are times when the Silver Eagles, which are made by the U.S. Mint, are very high in premium, and they're maybe not worth buying. It may be cheaper to buy Silver Britannia 1-ounce coins made by the Royal Mint over in England, because you could save $4 or $5 an ounce.
So just diversify the coins that you do accumulate. Diversify. So find the one that has the least amount of premium at the time.
Yeah, this amount of premium, and then once you accumulate, let's say you're an individual that says, listen, I want to have some coins for diversification in case I need to barter. And then once you hit that point, then you say, okay, now I want to invest in physical metal, because now I want the price action. I'm really more interested about owning the physical for the price action down the road, and I'm not going to take my 100-ounce silver bar down to the local grocery store and buy groceries with it. So in that instance, you're buying, the larger the bar, the cheaper the premium gets. So therefore, you can kind of diversify your product holdings in that fashion.
Because the practicality, like you said, of bringing a 100-pound bar, well, it feels like I need to bring a 100-pound bar every time I go to Costco, and I think that would be sufficient.
Sure.
Okay. What is your opinion on the real estate market?
The real estate market, it's being, I think it's crazy.
We're in Idaho, so we're in one of the largest booming areas around. So yeah, we it's crazy around here, but I know it's crazy in a lot of places.
Yeah, the real estate market, the concerns, just like we have with the bond market is probably the most overpriced market or asset on planet Earth. Having a zero interest rate or almost a zero interest rate type of mentality where most of this debt will never be paid back is just insane to me. But by having that zero interest rate environment, the quantitative easing that's done by the Federal Reserve, people don't understand when the Fed is buying back or adding to their balance sheet to the tune of $180 billion a month. $120 billion of that is coming from, they're buying mortgage-backed securities that are being refinanced, paid back, but paid down by the Fed or by the holdings of the Fed. Then the Fed goes out and buys more mortgage-backed securities. By them doing that, adds more money into the system, and it's sort of a self-feeding mechanism that supports not only the real estate market but supports asset prices as well. I don't know how far that will go until we hit this breaking point, whether it's inflation, whether it's energy, because you're seeing these energy squeezes all over the world. The more of the money printing to try and keep the economy revved up, the more fiscal spending you see happening. It's putting more pressure on commodities out there, because you are seeing supply chain issues. You are seeing a lot of labor issues and so forth, and that's sort of seeping in, and that's creating this inflationary wave that we're seeing.
So I'm going to wrap up our interview, because this is just the introduction, and I think you said we could do another sit down if we needed to, because all of our members, this is going to just open up the floodgates for more questions. So thank you. I hope you will agree to come back. But what questions should I have asked? What do you think is as traders that we should know about the market that most traders don't, about commodities, gold, metals?
Yeah, from the commodity standpoint, I would probably say, looking at from a relative value, I mean, I guess it depends. If you're a short-term day trader to a momentum trader to maybe a swing trader. Is looking at where the market, or where the economy, not necessarily the economy, but where the liquidity is headed in this whole system. And to me, any hiccup that forms, you have a lot of talk right now that the Fed is going to talk about tapering.
Right.
Well, tapering isn't tightening. Tapering is just printing less money. They're still adding to their balance sheet. So understanding that sort of scenario, to maybe bet against the stock market right now may be a little bit premature, only because they're still adding a lot of money into the system. At some point, my theory is that we're going to see an inflationary run, because people are going to be saying, okay, gold, silver have underperformed the market over the last year, and I think they're starting to rev up here. I think you're seeing sentiment levels they got very negative, like they've seen at other lows over the last 2 or 3 years, and you're seeing some of the positioning amongst with central banks going into the market and buying where maybe the retail public isn't necessarily buying. It's telling you the smart money is
where the money's going. Following the money.
So as long as you see that trend developing, especially if you're a swing trader or you're a little bit longer term oriented, you can have a little bit more confidence that the wind's at your back. The issue you run into is if interest rates are starting to really rip to the upside, then the Fed is saying, at this point, we're not just going to taper, we're going to start pulling money out of the system. Then you could have a March 2020 event where you see a deleveraging event that could really whack a lot of assets. So that's always a possibility. But right now, they're still trying to throw money into the system.
The printing presses are on, and no taper tantrum yet. So I need to follow up with one thing that you said. You said that silver is positioned, or I think I heard that silver's positioned better than gold right now. The chart or the industry?
Yeah, from a standpoint, there's an old adage: 90% of the move in silver comes in the last 10% of the time. So silver tends to be an asset that it kind of moves like a hockey stick. It goes nowhere for a very long period of time, and all of a sudden it just breaks out to the upside or downside. But the issue right now is silver has so underperformed gold on a relative basis over time here, that when it went to 125-1 on that gold silver ratio back in March of 2020, that was probably a level we'll never see again in a generation. I mean, that was extreme, and I think you're now going to see the rubber band it's going to be snapped back in the other direction, and I think you're going to see silver now lead the charge and typically in an inflationary time frame, silver tends to perform a lot better than gold during that inflationary move. Now, the question is it going to be a steady move up, like a 45-degree angle, or is it going to be, where it just starts to get exponential in a very quick period of time? Whether you use like a French curve or whatever it may be.
A parabolic move.
Yeah,
It definitely could be. We love when commodities go parabolic. Recently, nat gas went parabolic. We have fun with those days. We have a lot of fun. You were so generous with your time, and you were very patient with me and my questions that aren't so informed. So I appreciate it. Thank you.
Sure, my pleasure.
Thank you for letting my little dog crash our party. All right. Well, thank you so much. And I hope to see you soon. And I'll gather the next round of questions if they come up from this session.
Sounds good. Thanks, Lori.
All right.